Good evening, ladies and gentlemen. Welcome back to CIBC Presents Entrepreneurship 101. Couple of reminders regarding the Upstart competition. The deadline for the three-pager summaries is Friday the 13th, which is fast approaching. If you got any questions, give me a call or send an email to the website, and we're happy to help. And we have settled on a date for the presentation, and that will be Wednesday, April 29th. It'll be one of the rooms upstairs. I'm not entirely sure which one, and it will probably run, the presentations will run from likely 1 until 4 with a reception afterwards, okay? So get to work on those summaries to submit. So, delighted to welcome tonight's speaker, friend and colleague of mine, Kerri Golden. Kerri and I work together in Prime Access Technology Ventures, early stage venture fund. But Kerri has an interesting background. She's a CA, an HBA from the Ivy School of Business at UWO, and she has been, I guess the nice thing about being a CA is that it's very portable. So she has been, and I'm just looking here, she was the CEO for Bell Mobility Paging, VP of Finance for Bell Mobility, which was formerly BCE Mobile Communications. But, and I'm trying to find, yeah, she was CFO for Alliance Atlantis, the movie and TV folks. And she was CFO for Loris Therapeutics, an early stage biotechnology company. So Kerri has served in a variety of different technology disciplines, but the one thing I can tell you that Kerri does, that she did with me, is keep you on the straight and narrow on budgeting and finance. And in Prime Access, she has served on the boards and worked with a lot of our investee companies. And I've asked Kerri, and this is the third year that you've done this for the class, to talk about budgeting, okay, and financial planning. Now, you heard Peter Evans talk to you and show you on a slide how marketing fits into all sorts of different places in your business plan and your pitch. Okay, that's what a marketing person will tell you, is how important marketing is to the company. And that's kind of a self-consistent approach to things. Bottom line, an investor is looking at your budget and your profit forecasts. That's what it may be the last thing that's down there, but you better believe they're looking at your financial model. How are you planning to make money? And I guess the subtitle that we sent out is, fail to plan, plan to fail. So Kerri's going to talk to us tonight about financial planning and structuring things and presenting things in a way that your potential investors and other folks will understand and believe. So Kerri, over to you.
Thanks, Tony, and glad to see so many people out actually on a cold, wintry night, which seems to be a theme when I'm invited to this event. I'm going to talk about the financial piece, and I don't know, Tony, have you gone through the business plan yet, or is that after this?
After this, but Peter had a
similar slide.
You can see where marketing drops off, and he emphasized how important that is.
And it is, and actually, I'm actually going to support Peter probably in some of the things I say tonight, particularly when I look at the economic climate that we currently are operating in. Getting to early sales in your business is probably the most important thing I'll say today, and say it over and over again. And so where we obviously fit into the business plan is usually the last section, which talks about all of the financial impacts of all of the other sections of your business plan. And clearly very, very tied to your execution plan. And I do have a couple of slides where we'll talk about how you can make it clear to your investor what you're doing from an execution perspective in your business, but also then translate that into numbers. And then how much money you need, and what kind of profit you're going to generate from this business down the road. Because if I'm going to invest $1 million or $10 million in your business, I obviously want that money back with a return on it at some point down the road. So before you start, kind of things you need to have together. And if you guys just hold on one sec, I just want to, my own computer's locking here. My eyes aren't great, so I'm going to use my own here to see. And so, obviously you need to have thought through your whole product and technology roadmap. You need to know, obviously, what it's going to cost for your technology, how much it's going to cost to build it, if it is an actual technical product rather than a software or a service, how that product's going to evolve over time, because clearly when you build it in the capacity of one, it's going to cost probably a lot more than hopefully it's going to cost you to build and ship it in volume. You need market information, what your target sales are in number of units, what's your pricing strategy, what kind of a sales team and distribution strategy you're going to have, a partnership, and how you're going to compensate those people. From your sales and marketing plan, you also need how you're going to the market. What are the marketing activities? What kind of distribution chain are you going to be using, and how do you engage with that? And also your operations and execution plan. So what kind of a support team do you need? What kind of testing, equipment, those types of things. I'm going to borrow, sorry, too many buttons. I'm going to borrow a story actually from a little internet thing. That I happen to be doing in some research for another project I'm working on. And so the story goes, Sally, she gets a great idea. She gets some money, and let's say in Canada that money may have come in the form of grants or friends and family. She spends all of it developing her product. She runs out of cash, she's bankrupt, and unfortunately that's the end of her entrepreneurial dream. And unfortunately in Canada this happens a lot. That's probably more the US version. The Canadian version sometimes goes like they keep giving them government funding and the company never goes away. And that's what many of the US venture capital folks who come and visit us say about Canadian companies. And so, how do we kind of get out of that rut? And so I want to say, let's look at what went wrong for Sally. So she spent all the money developing the technology or product, and she spent almost no time or money selling, marketing the product to her customers. Like most technology entrepreneurs, she assumed that marketing and sales was easy. Those guys like Peter Evans can, do the job in their sleep, and I'll figure that all out once I've got the perfect product knocked out. And, at that point, all the customers are going to come running to me and want to buy my product. And they're going to be so impressed that we've done such a great job with our product that, of course, they're going to be buying it. She didn't really use her milestone to achieve business milestones that would let her raise more money. Investors are always looking for investments that have customer traction. And customer traction to an early company just may be having gone and met with them, got some feedback, saying that, if you build this product and it does what you say it will, that I would be interested in buying it. But that's certainly more true in tough economic times, because people don't really want to take a chance on something that may have a long development life cycle and cost a lot of money to develop. They'd much rather take a chance on something that's short to market, got some customer feedback, start to have some early sales. She also missed the opportunity to avoid some dilution and, avoid some of her startup's dependence on getting money from other people, because early sales means money that you can actually spend to do more development or other activities in your business. So what do you need for your financial plan? The first thing you need is a cash flow forecast. And that really is how much money you need for the business now and over that forecast period. And what milestones will you accomplish with that money? You also need a business income statement. So you need things like sales forecast, margin, net profit and loss. You should really consider 3 scenarios. And these can be done internally for yourselves. But you should take the optimistic view of the world. You should then look at what happens in the worst case scenario? How much money do I need to survive if I don't get the sales traction that I'm looking for? And then come up with what's a more probable case for your business in the period you're talking about. It should help you and prospective investors determine what level of sales are needed to generate a profit in the business. So at what point are you going to actually break even based on your sales projections? And when is that? If that's 10 years from now, you're probably not very attractive in today's market. If that's within a 2 to 3 year horizon, you're probably very attractive in the marketplace, and maybe slightly longer depending on the type of business you're in. Certainly, obviously, in life sciences, if you're doing a pharmaceutical play, it's going to take a little longer and a little more money to get there. And you also need to consider what changes or factors are critical in that plan and are going to have the greatest impact on profitability and timing. Because as a venture capitalist, I'm going to ask you, what are, the trigger points in your plan? If this doesn't happen or if this happens, how are you going to compensate from that? Either, an overrun of expenses or an underperformance on the top line. The cash forecast, to me, is the key tool for any beginning entrepreneur. So it's king in startups, as you all know, and I'm sure you live and breathe week to week by how much cash you have coming into your business. So it's something you need to look at, daily, weekly, and understanding that is really key to your success. So you're going to need to forecast how much total money you're going to need over your business life. What is the logical timing? And so it's like, well, I'd really like to go raise $10 million if I could. But do I really have the milestones today and the valuation today that would let me do that? So maybe I'm better to go raise $1 or $2 million now and then, build some value into my business, build some proof points with customers, and then maybe I only need to raise 5 or 6 million in, maybe a second or a third round for my business beyond that. So based on that, you're going to estimate what kind of round size you're going to have and how much you can reasonably invest yourself. I think in today's economy, many investors, angel investors, friends and family, want to know how much skin in the game you're willing to put in. And sometimes that may be in the form of cash from your savings, and sometimes that may be in your willingness, obviously, to work for what I call sweat equity, which is either free or lower than market wages in the business. And then how much can you logically raise from your network of investors? If you're not in a network where a lot of external investors, setting a round size that says I'm going to go and just, right out of the gate, go and raise $10 million from people I don't know is very difficult in good times, and I would say is almost impossible in bad times. You want to develop forecasts for time horizons that make sense. So for your internal use, monthly, weekly, for your near-term management needs. For investors, usually if you're looking at a first round that may last you somewhere from 12 to 24 months of cash, you probably want to budget that on a monthly basis. But beyond that, it's fine to just budget it in quarters or, as you get out to some of the later years in your plan, to make that an annual forecast. And so here's an example of a cash flow forecast. So the main things you have obviously are the receipts coming in, generally equity or debt, on how you financed your business. Payroll expenses and the types of companies that I think probably most of the people in this room are working on would be the biggest thing. There may be some supplier expenses like rent and equipment and other supplier items. You may have a grant. The 15K is, I think, the Young Entrepreneur Grant that is available from MRI that I put in there. And then on a 1 year basis out, you also would be able to claim scientific research and experimental development tax credits and the Ontario Investment Tax Credit based on the R&D work that you were doing. But the timing of that cash wouldn't come in until the following year once you filed your tax return. And so that's just giving you an example of what a cash flow would look like for a business that raised $250,000 in its first round, $500,000 in its second, and another $500,000 in its third round. This is a product development schedule that I've actually borrowed from a company that has some very experienced entrepreneurs that have built about 5 businesses. And so they come from a world where it does take a really good 18 months to have a solid, commercially available product. But being smart and knowing that the market is currently tough for financing, they've raised $2 million US of seed funding, but want that to last as long as possible, and also want to make that next round not as large and let's say challenging to raise in the current market times. So they've taken a look and said, we can get a proof of concept out quite early with that money we've raised, the seed money, and a very early feature set and some live processing of data for what we're doing. But then instead of waiting and having our trials just at the time when our first commercial shipments are starting to kick in, we can get some lab trials going, and maybe we can get some feedback from customers. So this gives us a couple things. Gives us early feedback on what features the customers like, what things aren't in the product, some testing of the product in a safe environment. Clearly, these are going to be trials that customers are not going to pay for, or obviously pay for at a very discounted rate. But it also lets us talk to investors, again, with some feedback much earlier than if we had waited till we started to ship product at the end of the 18-month cycle. And so I think this is how smart companies are looking at their product development plans and finding a way to do it incrementally. It allows you perhaps to self-finance part of it yourselves or through your family and friends network or angel investors, and build some value. Because if it's a validated product, it's working, and there's customer traction, usually the valuation of the business is higher than it would be if you just have an idea and a proof of concept back at the beginning. The other thing I wanted to show you is you should be thinking about, and it kind of comes back to whether customers and marketing and sales is important. This company is also not waiting until a couple of months before it has commercial product to bring in business development or salespeople into its organization. And so it's also mapped out what milestones it's doing from a customer and a business perspective over that same horizon. So right now they've written their business plan. They've had some early customer meetings, gathering customer requirements, for their product requirements document. They're developing a go-to-market plan and a customer business case, which says, if I build this product for X and I deliver, this type of performance in the way of enhanced quality and price performance and lower bandwidth in their case, what does the business case look like to the customer? And they're testing that out with customer and partner meetings in the marketplace. They'll obviously be doing customer demos just before they go into lab trials. They will be obviously managing it and the feedback coming in from the lab trials, and then they will look to obviously finalize their pricing and initial contracts before they get into their PR and launch plan. So you can see this is pretty much on a parallel path to your development effort. So it may not be the same number of people working on it, but if you don't have at least one or two people in your organization thinking about these things from the beginning, it's likely that you may not be able to raise funding. It's also likely that you may build a product that doesn't necessarily meet what the customer is looking for in the market. And so the other tool I said we needed was a business income statement. And so your top line revenue should be derived from your market forecasts on the business, but also a bottom-up view of customers. And so, we all can access nice analyst reports, and I know here at Mars you can certainly access them through many of the resources available to you. But a much more credible market forecast will show as well, if I were to get this many customers from the bottom up and they were buying this many units from me, it's a much more credible way to look at a forecast. You obviously need your pricing and cost assumptions for your product and your business model. And you need to consider the pros and cons of the hockey stick. Does everybody know what the hockey stick is? Well, the hockey stick is your typical sales forecast you see for any early stage company, which says, I'm going to have a revenue target that's very low in the first few years. So I might sell $100,000 year one, $300,000 year three, and $50 million in year six. And so clearly it looks like a good old Canadian hockey stick. And so the pros of the hockey stick are a lot of investors are not going to be interested in your business unless they see a large market opportunity for it. The con is it's very difficult for any company to actually execute on a hockey stick. And so, after all these years of experience, I'm working in a startup right now, we have the debate internally ourselves. If we set a more reasonable hockey stick, what does that mean? And we also concluded that the investors generally will knock down those numbers anyways in the later years. So it's probably okay to be a little bit more aggressive than you really think you can do. But certainly in those nearer term years, you really need to look at what you can deliver and what it takes to deliver that and ensure that there's credibility in your plan. From an expense perspective, you're going to develop your forecast from the bottom up based on what you expect to happen. You can review benchmarks for other companies. So there are obviously companies in the technology businesses that have gone public, and when they go public, they will publish what their early expense numbers look like from the very beginning of time. And so you can look through those and get an idea of how much they're spending on R&D versus sales and marketing and G&A expenses and the types of expenses they have. And so you can compare yourself, your later years to some of those benchmarks that are out there in the public domain. You also want to identify how many of your costs are actually fixed. So there are things you can't change. So I hired 10 people at a salary of $50,000 a year. I have a fixed cost of $500,000 versus variable. So things like I'm going to pay people a commission, a percentage of how much they sell. And so those are things that you want to think about in your plan. EBITDA is, the measure of how your business performs, and that is earnings before interest, depreciation, and amortization and taxes. And the benchmark really for exit values in merger and acquisition deals and performance of public companies. So ultimately over time, you obviously want to be generating positive EBITDA. So if we look at an income statement there, we've got our sales, cost of sales, and gross margin, and that's what I'm going to focus on in this next slide. So this is a slide that was a bad slide that I've obviously not said which company it's from, but it was a company that approached me about investment. And this is the wrong way, I think, to present your market forecast to a venture capitalist. So the entrepreneur comes in and says, we only need 1% of this really large $30 billion market or $3 billion market by year 5, and we've kind of worked backwards in the plan to come up with numbers that go in the hockey stick from, let's say, $500,000 up to $30 million. My tip for you is it's better to segment the market and show your market share in relationship to a specific, smaller subsegment of the market. Investors like to back companies that are winners, people that are going to generate significant market share in their space, something like 15 to 25%, and are focused in their approach. And so that is a much better way to present what you're doing to an investor. You can still say that if you're really successful in that sub-segment, that your plan has upside potential. And so you can still say, okay, I'm not focused, in our case, we're focused on internet, but there's also an opportunity in mobile and IPTV. And so we can show those as upside markets. But our whole business plan and financials are around being successful in that internet market, which allows us, as a small company, to really focus on what our niche is, as opposed to spreading ourselves too thin. And so the way I would suggest you show me your sales forecast is something like this. And this is an example. In this company's case, they're distributing their product through doctors, and they're going to recruit doctors as follows. So they have 150 in year 1 through trade shows, and by the time they came to me for an investment, they already had 60 doctors signed up. So 2,400 doctors by year 5, serving up to 30,000 patients seems like a reasonable number to me. And so it's much easier for me as the investor to relate to that. The product pricing, $1,000 per year, and the pricing starts at $1,200 per year, but over time, competition drives the price down. It requires 6 regional sales and support reps to support the doctor network. This is a much more credible way to get to that $30 million a year of revenue than the previous chart for investors. Other things to think about when forecasting sales. You need to realize that different distribution models, which I'm sure Peter took you through in the last couple of lectures, may result in multiple prices for the product. So you need to see what's the price to the end customer, and perhaps even to the end customer, there's going to be some discounts that you put in place. You need to consider as well what that wholesale price will be for distribution partners you have or OEM relationships. So in those cases, you may actually be selling to them at a number that's 40 to 60% less than your list selling price to customers because they're going to be doing a lot of the sales and marketing work for you in the business. Currency is quite a challenge right now. Obviously, most of our Canadian companies sell their product in the US and around the world. And you need to validate and state your assumptions in the plan. The current volatility is a problem, though, for companies. And so you want to err on the side of conservatism in your plan. So for your expenses, if they're in US dollars, you probably want to have a fairly conservative rate. Your revenues, if they're coming in US dollars, the flip side of that may be a little different rate. Because if you raise money, say 500,000 Canadian, assuming that anything you have coming in US dollars is at one exchange rate and it's significantly different than that, like the swing we saw last year from par to I think 1.28 at one point, it can be quite a difference in what your actual cash will buy you. And so you need to kind of think about those things as you're putting your plan together, particularly because the plan will run multi-years. And service revenues obviously depend on the various consulting rates that you would charge in the marketplace. Always ask yourself the Dilbert question, is the plan realistic? Because in this particular case, obviously, they're assuming that there's an armored car coming through the wall with some money in it. And there's a comet striking oil for them to make their revenue plan. So once you've got it prepared, you've got to stand back, look at it, and see whether it makes sense and it's realistic, and that you're going to have some credibility presenting that to an investor. For cost of sales and gross margin, these are the direct costs, obviously, of producing your product. Those costs evolve over time. Labor costs generally increase, but they often drop as a percentage of actually producing the product. And you should plan for cost reductions. A lot of times people get a prototype into the market first, and then they will look to re-engineer it for low cost as they look to expand their channels to distribute the product. And that's a very good way as well to stage how much you're spending on the development of the product. Gross margin obviously gets expressed in terms of dollars and a percentage. You should definitely understand what the margins are in your business. A lot of investors will ask you that question. And there's a couple of examples. Software companies tend to be in the 80 to 90% range, and product companies that are attractive tend to be in the 45 to 60% margin range. The next sort of set of line items we have here is our research and development expenses, our selling expenses, and our admin expenses. And so that's what I'll focus on next. So R&D expenses, probably the comfort zone for most of the people in this room. The largest component is generally labor. They should, obviously consider what your team needs to look like at the beginning, but also what it needs to look like a ways out, time for testing and QA. It must address whatever sustaining work you need to do on your product and what the support's like. If you have patents and trade secrets, you need to forecast those costs. You may need to forecast costs of using other people's technology in your technology. And then, obviously, in Canada, we have a very nice situation where certainly the tax credits and the grants can very much be used to help stretch your R&D budget. It's about 35% of the first $2 million federally that you spend per year, and 10% in Ontario, which isn't capped. So that can be a pretty nice contribution to your R&D efforts that you don't want to not forget or not think about accessing. But selling expenses are what drives your growth. So this is an example from a company called Newbridge that was obviously started by Terry Matthews, a very successful entrepreneur here in Canada. So if Sally had been Terry Matthews, she might have spent 50% plus on selling and only 33% of the money on R&D to generate a spectacular hockey stick that Newbridge was able to put together before they sold their company very successfully to Alcatel. And it was interesting on that website that I had taken the Sally story from, they asked the question, should you spend 10% on sales and marketing? Should you spend 25% on sales and marketing or 55%? And they clearly believe that you need to spend more than 55% of your budget on sales to generate the kind of business that's attractive over periods of time. Now, that can be phased, clearly, which we'll talk about, but that's what we see. And we also see that Newbridge is not alone. If we look at some very successful companies out there you'd recognize, like Cisco, Adobe, and F5, you can see their numbers as well. These are obviously mature companies. Cisco has an absolutely phenomenal EBITDA number, and so that's why the expenses are a little bit on the lower side. But you can see they're certainly spending almost 2 to 1 in sales and marketing what they are on R&D. So that's clearly where you get to at the end of the curve. And here's the items that you find in selling expenses. So you've got your sales and marketing teams, usually a team that's geographically remote, your commission. And so you need to plan, within your industry, how you're going to recruit salespeople to sell your product. You can't have a completely different scheme than others. So you're going to have to look at something competitive in your marketplace, but something you can afford as a startup. Marketing costs, things like PR, advertising, trade shows, website. I'm sure Peter went through a lot of this stuff in fairly detail about how to do it, but you need to put the cost of those things into your plan. And travel, living, and entertainment can also be a fairly large expense item in this area. On that side, though, you want to ensure you put some performance measures in place to ensure that the cost of pursuing a customer matches with the margins you're going to get back. You don't want to spend $100,000 getting a customer to find out that they're only going to give you $50,000 of revenue and $25,000 of margin over its life. So you really need to think about that going in. What's in admin expenses? So you've got your operations, customer support, finance, HR, IT, CEO. Excuse me. Your rent, your telephone costs, recruiting and other HR costs. Recruiting, a lot of people think we can just do it by word of mouth. Often that's true in your home markets, but as you expand geographically, it can be a bit more difficult to grow your team, and you may need to use outside services. Professional fees, board, investor relations costs, travel expenses, and miscellaneous type things. This is a little tool called the business case. So once you've done your initial plan, you've built your first version of the product, you should really always ask yourself, is the incremental work I'm going to do to release a new version of the product or a secondary product going to pay for itself? So this is a little tool that we use, which says, how much is the R&D cost? What's it going to cost to sell this product? What's the incremental level of G&A cost I'm going to have? And is it going to generate a positive margin over time? And so this is the kind of discipline that you want to introduce into your business, probably, in the second or third year of producing products. Just quickly, I'm going to show you a balance sheet. If you're not comfortable with financial things, you can get away with not putting this into your package, as long as you have a good handle on the cash and how much profit your business is going to generate in sales and the cost of it. You're pretty good going to a VC, and hopefully if you get, or even an angel or other investor, and hopefully if you raise money with them, you'll be able to afford to hire an accountant and have them do the balance sheet for you. But just to give you a little idea of what's on that, obviously you've got your cash, your receivables, inventory, fixed assets, liabilities, the financing amount coming in, and then your retained earnings or loss. So just what these things are. Receivable is an asset. If your assets are increasing, you're actually using your cash, because it means someone's deferring a payment to you. So in the case of accounts receivable, these would be things like your customer payments, any tax credits, grants, GST. And as the business grows, this may be something you need to fund. Now, the good news is you don't have to necessarily raise equity to fund the growth of your business from an accounts receivable perspective. There are certainly organizations and banks that will offer financing based on your receivables. Inventory and prepaid expenses are generally things you have to pay in advance. Fixed assets, if you have a very capital-intensive business, you need to obviously forecast what those are and what those expenses are. The liabilities and the equity is really, if you increase those, means you've got money in. So by delaying payments to your suppliers, and you would obviously need to look at what your business cycle is, you could have things like leases and taxes payable. Debt financing, for early stage companies, obviously a bank loan comes with the requirement for you to give a personal guarantee from the business owner, which is generally not something most of us are happy to do. A small business loan for equipment is offered actually through many of the Canadian banks. It is backed by the government, and so the requirements on it are quite a bit less, and it's up to $250,000 for a business that has capital needs. It can fund capital and leasehold improvements for your business. Venture debt is something that's usually available only in sort of large equity rounds of financing when a venture capital firm is in the picture. We talked a little bit about operating line of credit. It's usually something once you're starting to generate receivables and you may be able to use for your inventory needs, and a long-term equipment loan beyond that $250,000 government-backed program, is something that's usually only available in the longer term. And then on the equity financing side, you have the proceeds from the sale of your either common or preferred shares that you would issue to your investors. So some final thoughts before I take some questions. Your business and execution plan is quantified in your financial plan. You've got to have those things consistent. So having a plan that says I'm going to do all these things, but your financials only show I'm going to spend $30,000 on R&D is really not going to give you any credibility with an investor. And the key aspects of your business plan, they need to be researched in advance before you start really working on the financial plan. Clearly, investors that are familiar with early stage companies like Tony and I, know that financial plans are always a work in progress. So you don't have to have everything tied down before you can have that conversation, but you still need to tell me, I'm going to need 500,000 versus I'm going to need 500 million to build my business, and my sales are going to be 5 million versus 50 million. You need to really have an idea of what type of a business you're forming. Be honest about where you are more comfortable in your projections, and sometimes they'll be able to help you refine some of those other areas of the plan. Obviously, monitoring your business against the plan you set is just as important or more as developing the plan. And in today's economic times, it's important to develop a plan that gets you to early sales and early cash flow to be successful. So thanks very much for your time, and I'm happy to take any of your questions.
How many businesses get funding before they have things like customers willing to pay or significant R&D progress?
It's a good question, and I don't know that I know the exact answer to it, because obviously some get funded in small amounts through government programs or through their friends and family. But just from a venture capital perspective, things that get funded early, it's probably about 1% of companies that are created. Yeah.
How long should your projections be? Like 5 years, 7 years?
I would say.
Kerri, could you repeat the question?
Sure.
I'm sure everyone could hear.
Yeah, the question was how long should your projections be? 5 years, 7 years? I would say that you need to go out for a reasonable amount of time. And so I would go out in detail for at least a couple of years, but at a high level, understanding how much revenue and perhaps what the margin looks like, I would recommend going out 5.
If you plan to develop a product and take 2 years to do that, would 5 years still be a good enough projection with 2 years and 3 years actual?
You may, in that case, want to show more years. And I wouldn't necessarily worry about going into all the bottom up on the expenses for those outer years, but you may need to show those 7 years just so that you start to show your hockey stick. Because it may be that, obviously, your revenues won't kick in till year 3 sometime when you're shipping the product. Yep.
What would be the difference, if you notice, the difference in climate between BC and New York compared to Toronto?
I'd say they're not very happy at all in New York. That's where my company's from. Not to say they're agitated in any way, but the market there is very difficult right now. Just clearly, most of the people that were doing venture type funding tended to be in other parts of the market, and obviously have taken quite a bloodbath there. So now here we also have some challenges with the number of funds that have cash available to be funded. So it's a bit of a toss-up. I would think that Boston and Silicon Valley are still probably a little bit better places to be than Toronto. New York may be worse just because of the fact that people are getting laid off in the financial community. I think, hourly in this market.
When creating your financials, how do you make your numbers? Do you base it on your optimistic, pessimistic, or your probable?
The ones I would show to your investor is the probable. Yeah, and as I say, in those outer years, you might want to have a little bit of optimism in the revenue side. So if you do a plan and you say, I'm only going to do $5 million within 5 years, you may want to be stretching it up to your upper limit at that last year that says, no, I can do 10, if that's the number. Sorry, way in the back? Sorry, yeah. Yeah, I will. Sure.
I'll tell you more on the marketing side, but what are your suggestions of the factors to consider when determining pricing?
I think you need to look at a few things. So you obviously need to look at products. What do you need to determine pricing? What's your best suggestions for determining pricing? I think you need to look at what's going on in the market. So you're targeting your product at a particular market. Sometimes you'll have a product that's kind of a new category, and so those are the most difficult. And what you want to do with those is look at things that may be what you're displacing. And so if there's a product that costs X that does a part of what you do or that you're going to eliminate, you might want to look at how that's priced in the marketplace. So you clearly need to be gathering data points from what's available in the market. You then need to, though, look at your customer business case. So how much money can you potentially save, or how much additional revenue can you generate for your customer? And quality is the hardest one. So sometimes you're improving the quality and putting a price on that. Will someone pay a 5%, a 10%, a 20% premium on that? There's certainly some articles out on the web that talk about some of those aspects that you could probably look for through Google. Sure.
Is it possible to get financing for intangible assets?
The question is it possible to get financing for intangible assets? And so the answer, if you're thinking about a traditional Canadian bank, is no. So they will not secure a loan against intellectual property assets or other intangibles. So really you're talking about an investor of some type. So there are some investor groups that will give you what I would call a convertible debenture. The Investment Accelerator Fund, actually, which operates out of Mars here, does take that approach. But generally speaking, no. It's an equity investor that's willing to front those, let's say, startup intangible losses in developing your product.
Online pools like venture capital where you could submit your business plan to this unknown large audience and put everything? Or do you think that is safe and a good idea? And then on the other hand, do you think it's better to approach people personally, have to get a meeting with them?
Okay, I'll try and summarize the question. So the question is it better to take a personal or impersonal approach, which may be involving submission of a business plan over a website to getting to an investor? And so definitely personal. So do I ever read business plans that come in over the web? No, generally speaking, although some organizations do ask you to fill in at least a form to give them some information on it, which I wouldn't feel bad about. I would definitely not put any real confidential information or your special sauce on those, but you definitely want to get a personal connection. So I'll give you a few ideas of how you can get a personal connection when you don't know the person. So all VCs love to brag about their portfolio of companies on their website. So if you do some homework and figure out that a venture firm, may be a target for your business, you can go on that website and it will list the portfolio companies they have. And the people that work in those companies generally are just like you. They've started businesses. They're usually pretty friendly. And the best way to get a deal in front of a venture capitalist is to take it to one of the entrepreneurs they've backed and have them vet it. There's two benefits you get from that. First of all, we have a direct connection. We probably sit on their board or work with those companies regularly. But also, if they're in the same space as you and they're telling me, hey, I spoke to Tony and it's a great idea he has, it's some validation for me as well in the space, that it's not just something that's not qualified coming in. There's also, obviously Mars has some resources to introduce, to venture capitalists. There are certainly professional services companies like lawyers and accountants have some relationships with investors. And so I would always try to get that personal connection as your introduction, because you're going to go way higher in the pile than just filling it in online. As I say, there are some groups, though, that want that filled in line, just basic information about what it's in, because they may just want to tell you, oh, you have a biotech deal, and I don't do biotech. And so they want to avoid spending their time on things that they just know they're not going to look at. So, yep.
When creating your financials, you know, say the estimate, start using comparable numbers for projections. When it comes to deciding, like, whether or not you go big on your plan or you go conservative, something more realistic that you could start out, through just getting a standard loan, which way do you suggest?
So the question is how do you decide whether you go with a more conservative plan that you might be able to finance through a loan or your own money versus a go big plan? And I think in today's world, you're probably better to, if you don't have a lot of personal resource of yourselves and in your immediate family or network, I would say you probably want to take the conservative approach and prove your business and then try to raise money, because everyone recognizes at that point that it has a much bigger opportunity. That's probably what's going to get financed in the current market.
Hypothetically, you made your product, you spent your own money, hundreds of thousands of dollars on it.
Yep.
And you've tried to go for a VC. Every time you go to some place like Chase Ventures in New York or whatever, there's fog, fear of Google, of course, just copying everything you've done and putting out of business. What happens when you have an actual product or you have a set of services? What's the climate like in Toronto for actually getting to a venture capital firm, because they might have other clients or they might know people who they can match your technology up with?
And so I think the question is around, what's the risk of going to a venture capitalist who might have other things in their portfolio that they might disclose your invention to, et cetera? Is that kind of what we're saying?
No, I'm wondering more of, can you get an opportunity if you already have the product? You've shown you put it, obviously put in the time and money. Can you go to a venture capitalist in Toronto because they might be able to, A, help you out on the money side, but B, by giving you your first clients as well because of their portfolio of clients?
Oh, yeah, sorry, the question is could they help with clients and other things? Yes, and so when you do your homework on venture capital funds, you should look at their portfolio, you should look at the companies that they may have sold prior companies to, where they might have relationships, where they worked before. If Microsoft is a target for you, and you can notice on JL Albright's website that Rick Siegel worked for Microsoft, then he might be the right guy for you to go, because he probably still has relationships, in there that would help you sell your product to Microsoft. They also, if you're someone who has created a product or an idea, and you're not really that concerned about running the company yourself, they could also have a company in their portfolio that might be interested in your technology and acquiring it or licensing it or something like that as well. Yep.
What about sharing your financial model with potential investors? How's the best way to do that? Or do they just go ahead and make their own anyhow and go into those?
No, they definitely look at yours first. So I would suggest that you would put a few of the key assumptions into a PowerPoint deck, and then you would give them a copy of the model. So hopefully at that point you would have gone through some reasonable levels of due diligence with them, and you would sense whether they were truly interested or not interested in the business. And they will play with the model. So they will probably do some what if scenarios, kind of going between that optimistic, probable, and pessimistic scenarios to test the assumptions.
And then what's your favorite way of taking a financial model to come up with a valuation?
the question was, what's my favorite way to come up with a valuation? Well, I've dealt with early stage companies, so I generally don't use the financial model to come up with a valuation. I probably shouldn't admit that in the crowd while I'm being taped, but yes, it's very unlikely that I'm going to use that model. I can do that in later stage companies because I can then look at what the discounted cash flow is going to be and some other things that are bringing us towards an ultimate financial value on a market stock exchange or for M&A transactions, but it's very difficult at an early stage. So at an early stage, it's going to be anywhere from 0 to 10. And it's going to be based on how big an opportunity I see, how strong the management team is, have they got a track record of executing, and that's really a negotiation that's going to happen between the company and the investor. And I'd say that's pretty much consistent right through North America. There may be the odd exception for the serial entrepreneur that's, built $5 billion companies, but generally speaking, that's what we're talking about. Any others?
Okay, we can move to the one-on-one phase.
Yeah.
Join me in thanking